Every year, billions of dollars flow into mega real estate funds. And every year, those funds tend to outperform. It's not bad luck, it's mathematics. What's up, timeless investors? Welcome to another tactical investment focused video for our crew here on the Timeless Investor Show. Today, I'm exposing the $500 billion blind spot hiding in plain sight. Why the biggest funds with the smartest people consistently get beaten by operators working out of their garage or their mother's basement, whatever you have it. Once you see it, you can't unsee it. It's pure math, guys. I discovered this in the course of building my company, having worked for years at Goldman Sachs and then interfacing constantly with family offices all across the globe. And then I founded my firm and focused really on mid-market acquisitions. And there's a prevailing tendency amongst the investment crowd to believe that if you invest in some high and mighty Wall Street institutions fund, it'll do better because the pedigrees and the personalities that are running the fund are incredibly impressive. And we love stories. Humans love stories. We love good narratives, right? We love them. If you're a good narrative person, you'll make a killing in this world. It's a sure thing. Will your investors make a killing, though, is a bigger question. And the short answer is the pedigrees, the Wall Street personas, the mega funds do not produce the high returns. And I'm going to show you why, because it's really important to understand the structural problems behind the big brand name groups that are trying to get your capital. So let's look at transaction data first. And there's something really interesting and compelling here. Small deals, and I'm defining that as under $5 million deals, tons of volume, tons of transaction. Every doctor, every dentist, every small entrepreneur that's trying to buy a duplex or a fourplex or a fiveplex or a tenplex, depending on your market, they're all competing for it. There's a lot of people. There's a lot of pressure. You've got the small deals. You also have the owner occupants that are playing in that space, right? So somebody's trying to buy something and live in it and get a 30-year loan. It's a competitive space, okay? Now, flip to institutional, $50 million plus. Guess what? Tons of volume. Tons of volume. A lot of players, tons of money, not a lot of buildings. But in the middle, there is a valley. It's called the Valley of Opportunity. There's dramatically less activity going on in this space. So you can see this, guys, in the capitalization rates of assets that people are buying, right? Institutional size buildings tend to trade at a lower cap rate than mid-market buildings. Why? A lot of reasons. We're going to get into it. But a lower cap rate going in on a comparable asset isn't really giving you the return you're looking for. You are buying a beta play, right? And if you don't know the difference between alpha and beta, I'm going to get into this on another video for you guys, but it's really important. Beta is a stock market term, so is alpha, but you can apply it to real estate. Let me explain why. Beta is the market return. What does the market give you? You can think of it like being like an index fund investor. Alpha is the return that a manager generates above and beyond what the market actually produces. So if you look at real estate, alpha and beta exist just like anything else. It's harder to see because we don't have an S&P 500 index you can track. We do have some indices you can look at. But an institutional size building at a lower cap rate that's a newer build is going to ride market beta. There's not a lot the manager can do to drive excess return for you. They're just hoping the market they pick does a good job, okay? Alpha is generating return above and beyond what the market gives you, which is something that a more nimble, smaller, flexible operator can actually deliver, okay? And there's a lot of reasons why. Again, we're going to get into that. But you can see it. Institutional size buildings trade at 5 or lower cap rates, even today, even in the markets we're dealing with today. Mid-market buildings, same neighborhood, trading in the high 5s, low 6s. We have seen deals in our markets 7 to 8 caps, okay? In Seattle, in Portland, in prime locations that no institutional investor is touching. That is a big spread on the yield. And on a $10 million investment, if it's a 200 basis point difference, that is a $200,000 difference in return on an annual basis just from the yield for the same kind of real estate. So why would anyone pay more for less? The answer is mega funds don't have a choice. So here's the dirty secret of institutional real estate. When you manage a $500 million fund, you physically cannot buy small deals. If you have to deploy $500 million in $10 million chunks, you need 50 deals. That means 50 due diligence processes, 50 negotiations, 50 closings, 50 properties to manage. And that's not even counting the funnel above that to get to 50 deals, right? So is it 500 deals to get to 50? Is it 5,000 to get to 50? It's tough. The overhead alone kills you. So what do? They just chase bigger deals. Instead of a $10 million deal, they buy a $50 million deal, or better yet, a $100 million deal. And here's the problem. There just aren't that many $50 million plus deals. And every institutional fund is fishing in the same tiny pond. Blackstone, Starwood, pension funds, insurance companies, they're all competing for the same 100 buildings. And so what happens? Supply and demand, 30 buyers want to buy one building in a prime market that they all like. Prices go insane. Meanwhile, in the mid market, you maybe have 3 to 4 buyers per deal. Okay. It's way less competition and way more opportunity with the style of building, and there are higher returns. It is that simple. It is that simple. But it gets worse. It gets worse because these funds have a ticking clock. They raise $500 million. They charge a 2% management fee on deployed capital. No deployment, no fees. And they have typically 3 to 4 years to actually invest the money. If they don't, investors won't give them more for the next fund. So imagine this: year 1, we're being selective. Year 2, looking for the right opportunity. Year 3, okay, we need to move. Year 4, buy anything. They literally cannot wait for good deals. If you are a small operator doing a deal by deal outfit, you can wait for the right opportunity to come to you. A mega fund is often forced to buy whatever the market provides them at the time. And academic research proves this, okay? Mega funds consistently buy at market peaks, not because they're stupid, because they have to. I'm definitely not saying they're stupid. They're actually populated by incredibly intelligent people. There are structural forces that are beyond their control. Now, consider this as well. The mega fund industry, the big boys and girls, if I want to be correct, whatever, they have the easiest time raising their mega funds at market peaks. Hence, academic research points out that mega funds tend to buy at a peak. Why? They're procyclical. It's easy to raise money. Everybody's raising money. By the way, this affects small operators too. I just want to be very clear. Small operators, I felt it myself. I was an operator through 2020 through 2024 in, less favored markets, but it was much easier to raise money for me. It was easy for Blackstone to raise money, right? The B REIT, all these things came about in this time. There was a lot of money. It was frothy. There was a lot of stuff to do. And if you can raise a billion, $2 billion, $10 billion fund and clip those management fees, why wouldn't you? Right? Is it good for the investors? It's debatable. They will always give Blackstone money, right? And that's what I've found in a lot of conversations is a lot of family offices equate investing with XYZ firm with the smart thing to do. They're not going to get fired for giving money to XYZ big Wall Street firm. So they will always get money, even if the returns are not good. But we want to be mindful of this, the scale trap, as I call it. We want to be on top of it. There's another big advantage that favors small and nimble investors versus the big funds. It is, who are you buying from? The inefficiency advantage, I'm calling it. Big institutional deals come from REITs, pension funds, and other institutions. Professional sellers with teams of advisors. Everything is optimized. There is very little meat left on the bone. Remember my market beta and alpha example. It's a classic definition of a market beta deal. The only thing you could do with an institutional size deal with an institutional size owner is wait for market rents to increase. It is a beta deal. Unless you get a great price on it, which can happen, but it's hard to achieve when you have 30 buyers going after the same thing. But a mid-market deal, now let's talk about who you're buying from on this. Maybe you're buying it from the guy who bought it in 1987 and hasn't raised rent in 5 years. An estate sale where the kids just want cash. A burned out landlord who's been self-managing and needs out of the building. An owner who doesn't even know what a cap rate is. Okay. We bought a deal for $22 million, 134 unit complex, where the ownership was in the second year of ownership. They built the building, right? This is a classic mid-market play. And they hadn't raised rent in 5 years. under our prodding in the process, we asked them to raise rent because we didn't want to get behind on the process. It was the first time they had raised rent in like 5 to 7 years. The residents all had free utilities, right? You could argue it was baked into the rents, but everybody else at every other complex, the residents were additionally charged for their utilities. These guys had never done it. They just never did it, right? You will never find that. You will very rare. I'll never say never. You will very rarely find that in an institutional size deal. Rents way below market, expenses running crazy high, vacancy, like these things are really difficult to find. But an institutional fund, this deal I just described, would never buy it. It's too small, it's too messy, it's too hands-on. But that inefficiency, guys, is pure profit. It is the place to play if you want to make money in real estate. Small buildings have another massive advantage that the big boys are just not getting access to. They have an operational edge. In a 20-unit building, you can actually know every resident. You can respond to issues personally. You can build actual relationships. It is something that is so often missed in this business. It's like this world is divided into owner and tenant, and they hate each other. And there's this great clash, it's constantly. What if there was a win-win? What if residents were clients and you sought to deliver great service to them, be responsive to what they need, be reasonable, help them when there's a problem, and in turn, those residents stay with you. And yeah, maybe you raise their rent, maybe they pay a little bit more, but like it's a relationship, right? Like it's a relationship. That is incredibly valuable. Research shows that improving tenant retention by just 5% increases net operating income by 2% annually. Let me ask you, consider this if you've ever been a renter. Have you ever been a renter at a place where you hate the management company? They don't answer you, they never call you. If they offered you a price discount, have you ever been in a situation where you're like, you know what? I'm still going to get the hell out of here because I can't stand these guys, right? Or been at a place where like it's a mom and pop and you know them and they're there, they come in, they help you with stuff. Like you might have a better feeling about it. I mean, we've all been renters at some point in our life. Like I was in San Francisco in the heyday, it was incredibly expensive. Consider that, right? Is the owner of a 250 unit building able to develop that like tight relationship with their residents where there's like a collaborative relationship between the two? No, you're a faceless management company. Everything is automated. Residents, I like to say residents, not tenants. Residents are digits in an Excel spreadsheet to be milked for profit. Okay. We're all trying to get profit. Let's just be clear. I'm not saying that's wrong, but it could be done in a way that's like a mutually beneficial relationship. And the actual return is good for the investors. You can't do that. You can't do that. The big funds oftentimes have to use these major third-party management companies that are institutional in their own right. They manage 50,000, 100,000 units across the country. Like that's what you're dealing with versus the on-the-ground focused approach to retention and tenant satisfaction. It's a huge deal. Small operators can control everything. When something breaks, we can fix it. When a tenant has an issue, we can handle it immediately. That control creates value you cannot get at scale. But here's the killer. Big funds optimize for the wrong thing. They're not trying to maximize returns. They are trying to maximize fees. 2% of $10 billion is $200 million every single year, whether the fund makes money or it loses money. So what matters more, generating 15% returns on $500 million or generating 10% returns on $5 billion? The math is obvious. Scale pays better than performance. 10% on $5 billion feels a lot better for the sponsor if they're getting promoted on that than 20% on $100 million, right? Small funds do not have that luxury. We eat what we kill. If the deal doesn't perform, we don't eat. And that alignment changes everything. So where does that leave you? It leaves you, me, everyone else that's an investor in the driver's seat. Well, institutional capital is piling into the same 100 buildings in a market or less, right? There might be 20 in a market. While they compete each other into negative returns, while they deploy capital because they have to, not because they should, the mid-market sits wide open. $5 to $25 million deals, 100 to 150 basis points of extra yield. Sellers who don't know market value, inefficiencies you can actually fix and solve. You don't need $1 billion. You don't need 100 employees. You don't need Goldman Sachs on your resume. You need patience, discipline, and the ability to act when others can't. The scale trap is a real thing. Check out the pinned comment in the comments below. I've linked an article that I wrote, which has a lot more research, academic findings, tons of details for you guys to dig into. The bigger the fund, the worse the returns. Not sometimes, not maybe, basically always. Some of the best fund managers I've known have never raised more than $100 million funds. And I'm talking venture capital, I'm talking real estate, whatever it may be. And when I ask them why, these are top quartile measured by Preqin fund managers. Why? Why wouldn't you raise more? You get more fees. The answer is, I don't think I could deploy the money in a way that would make money for my investors if I raise so much. If I raise so much, I got a problem. It comes to my mind just as I'm talking to you guys right now. A really good example of this is SoftBank. And I think SoftBank is an amazing company. It's a really interesting vision. But one thing I noticed when I spent a lot of time in Latin America and SoftBank started investing in that market is they would take great companies and they would shove so much money into them because they had to. Scale issue, right? The scale trap exists everywhere. They would shove so much money into these companies that the companies would have to do abnormal, weird things that like no founder would actually do, but they had to justify the amount of billions of dollars that were shoved into the companies. They actually had a term for it in LATAM. It was the SoftBank effect, which was basically the companies that SoftBank poured money into tended to do worse, right? WeWork, one notable example in the United States. There are many other notable examples of this. In LATAM, Rappi, there's a couple other big tech companies. They got this massive cash injection, the cash cannon it turned on them. Did they do well? No. And that goes back to why did the $100 million funds not raise more? They know that. They know where they perform well and they delivered for their investors. It's a huge deal. This is a structural problem. It is a permanent problem and it's going to get worse. And consider that no allocator of capital will get fired for putting money with a major firm's fund. So they will always continue to raise funds that are giant fee raking mechanisms. That is their business model. And every dollar flowing into these mega funds makes your opportunity bigger and is good for me as well, because that's the place we play. More competition for institutional deals, less competition for everything else. And while they fight over the scraps in the institutional market, we can feast in the mid-market, in whatever market you play in. This is not a bug in the system. This is the system. Use it. Think well, act wisely, build something timeless.